Yes, ladies and gentlemen, market maker sure did say gotcha. Whoa, what's going on? What is going on? This is the problem we've got, right? Bitcoin reacts to Wall Street, but Bitcoin is recovering the way Bitcoin does. In tonight's live, I'm going to break it all down for you. Firstly, I want to apologize for not being able to go live earlier on today. But we've had a very interesting day, to say the least. Bitcoin clears that all-time high, gives a little kiss to the top side of it, and only pulls back because of the yields. So what actually happened? Earlier on, there was a 20-year bond auction, and it came in with a dismal demand. Why is the bond auction such an important thing for the markets? Well, it's the Federal Reserve saying, or the government saying, here you go, guys. We've got a sale on. Come into our shop. And here we've got the 20-year bonds. Would you like to commit to the long-term dated security that we are offering at this rate? Wall Street comes along and says, what's going on here? These guys are like, what are they offering? They're giving away this 20-year bond, man. Should we buy it? What, with tariffs? With no clear view on how many rate cuts we're going to get. I mean, the dollar's still expensive, so why am I going to go and borrow money right now, given that the rates are like 4.5%, 4.33 to be precise? Why am I going to go and put that money to work? I'll tell you what, for me to really put down the risk, I need a little bit more of a return on that bond. $16 billion was picked up. That is a terrible bond auction. And the market instantly reacted to that. And the NASDAQ completely wiped the floor. I was traveling today and I was just witnessing the NASDAQ making a move to the upside, turn onto the calendar. I was like, oh, we got a bond auction. Let's see what the boys are saying. And then it just dropped. It completely just wiped everyone clean. But fundamentally, when you see the NASDAQ especially climbing up, that is people selling. So the market in principle does need to reset to a degree. But the fuel behind this yield, or should I say the bond market not getting that much demand, is what caused everything to pull back really aggressively. Even Nvidia was up like 2% for the session. That's doing great. And then it ended up being negative. So you can see how receptive investors are at putting on risk and taking it off at the same time. They were selling all morning, ladies and gentlemen, and everything marked up. And this is something you got to take into consideration when you do trade. You got to say to yourself, when you go into the New York session, where is price at? Is it at a point where investors would like to buy? And is it or at a point that investors would like to sell? Okay? So I'm going to break it all down for you to put it into perspective, and then hopefully we can understand and make sense of the madness that's about to occur, because we've got our first bout of data coming up this week, ladies and gentlemen, and that's going to be important for us determining if whether or not NASDAQ's going to continue to go lower and Bitcoin has just touched the all-time high and it's not going to be going any further. Hopefully that's not the case. Let's get with the program, ladies and gentlemen. Here we go. So, stock slide as the weak treasury sale lifts yields. Now, this is a problem, as I said. It means that investors are seeking a higher rate of return for holding US debt. Going into it, 2-year yield shoots up towards 4.013%, so it's trading relatively well. The 5-year yield shoots up to 4.15%. You've got the 10-year yield coming in at 4.5% as well, and the 30-year yield is now trading above 5.08%. When they hit 5%, they then rejected that point. But now they've succeeded that. They've taken that point over, which tells us that they're going to seek a higher rate of return. This is not sustainable for the stock market. As you can see, the NASDAQ itself is down nearly 1.45% from being up so much. Look at that, just unbelievable move to the upside. And based on what I was saying to you earlier on, I mean, the hybrid system pretty much puts it into perspective. 3 vector candle move to the upside. They swept the highs over here, and then they just brought it straight back down at the start of the auction, which was at 6 o'clock. So even if you were going on the logic of a vector candle recovery, if this candlestick had traded positive and stayed positive, then there could have been the expectation that investors were looking to buy more bonds. But lately, what we've been seeing is investors have been buying shorter term dated securities, and we've been seeing those auctions doing relatively well. But when the longer term dated securities are being offered, like the 20-year, it's not come through. Going into the article, you can see it says here that Wall Street's worries about a ballooning deficit that threatens American status as a safe haven were reflected in a $16 billion treasury sale. Lackluster demand. So that's a bit of a problem. It says here that treasuries got hit after a weak auction of 20-year bonds whose 5% coupon rate was the highest since the tenor was reintroduced in 2020. So long-term dated bore the brunt of the selling. So that effectively means investors were like, I am not happy with this. I want a higher rate of return on my 30-year. I want a higher rate of return on my 10-year. I want a higher rate of return on my 5-year. So this is the situation that we've got. As long as the yields keep on moving up and wait for it. As long as the yields keep on moving up, the stock market's going to keep going down. I've said this before. Bitcoin needs a catastrophic event for it to start coming in as the alternative asset, the hedge against inflation, the safe haven, the store of value. Okay? Bitcoin's got more titles than Jesus, and we're waiting for it to come into play. Okay? And this is really important that you understand this, because if Bitcoin is the asset that's going to change everything, then a moment in the bonds market, which is what we're starting to see, if America or the status of America starts to come down and investors don't like it, that's when Bitcoin will continue to move up. That's where you will get the 135s. That's where you'll get the 200K Bitcoin. It needs a catastrophic event. And I believe that when the bond market fully crashes, by that time, Bitcoin would have exceeded easily the 150K mark. Easily. Because everyone would have come to the understanding that that's the place where it needs to be. Now, you might be saying, Artino's bullish now, start selling. No. Take the logic. Take the logic of what's going on. The NASDAQ is down and Bitcoin is up, but it's down not because there's a decoupling happening right now. Well, some of you might be of that impression that there is a decoupling, okay? But just look at the logic behind it. ETF balances are doing okay. There is accumulation from institutional investors, okay? There's a reason that investors are going into Bitcoin because they're not even going into dollar assets. They're seeing that US stocks are now probably going to be the ones that you might want to just claw back on. European stocks are doing great. Look, where we at? Euro, doing fine. Traded nicely to the upside. Happy days. It's slowly climbing. Investors are putting their money into the euros. They are on the belief that European stocks are going to outperform US stocks. So whatever Trump has in store for the US, he better pull out some ace cards, because confidence in the US right now is starting to dwindle, and it's dwindling pretty fast. Are we all on the same page with that? So, hi, what do you mean? Yeah, I'm doing good, my bro. What do you mean by prices going up equals people selling? Let me show you. Here it is. Remember what we said yesterday? These guys here are selling. Look, 106,000, 42 million. Going into today's shenanigans, 13 million, 2.5, 3.1, 5, 6, 5, 5, 5, again, 6, 10. Okay? These are all people that were placing limit orders and they were selling. Okay? When price goes up, people are selling. When price goes down, people are buying, because you can't buy without a seller and you can't sell without a buyer. Smart money, dumb money chart itself puts things into perspective. Remember what we said yesterday, that we're still expecting a little bit more of a rally to the upside with the market? Well, look at smart money over here. Let me just refresh this. Smart money in principle, this thing right here, we need this to go a little bit further down. And I'm expecting it to come down into a premium, into a zone which would then suggest that assets across the board are at premium prices, okay? Now, going over into the stock market to put it into perspective to help you understand it, looking left, we have got all this liquidity here. Nasdaq's got a gap down here that I'm not too keen on, okay? And tomorrow's data could put things into perspective. Unemployment claims are expected to only come in fractionally higher than what they were. If unemployment claims tomorrow come in and show that there are less people claiming benefit, ladies and gentlemen, we're going to have high interest rates for a longer period of time. Going into the actual readings, it's now increased to 94.7%. So that's the expectation that the next rate, the next readings of the interest rates, Fed's going to keep it at 4.25, 4.5%. What I'm looking for is for where it's going to end up in July. So July's reading, 71.2%. So they already know that in July, there's a good chance we're keeping it at 4.25%. This is really important at understanding this because it's going to give you the idea. Hold on. There we go. This is going to give you the idea of investors' expectations of the future. So if it's at 4.25, 4.5%, and that's in July, then that logically means that investors are still going to demand higher rates of return on the yields. So that means the yields are going to keep moving up. That means the stock market is more than likely going to keep on coming down. Okay? Now, the question is Bitcoin going to continue with its narrative to climb higher? The ETF balances, not really seeing anything coming off. They just seem like it's all doing well over here. But quite frankly, ladies and gentlemen, when we look at Bitcoin on the daily time frame, to put it into perspective, if Bitcoin is trying to tether away and go into its own thing, and investors are starting to see it as the alternative to American debt, American stocks, all right, then there's nothing stopping Bitcoin from continuing its rally higher. See, right now on the daily time frame, Bitcoin is trading above the 5 and 13 EMA. And as long as it sustains this rally to the upside, those of you in spot trades, retain it. All we now need to see Bitcoin doing is going into tomorrow's candle. If the data comes out tomorrow and shows that unemployment claims do give us the idea that the US economy is doing fine, that's going to be a little bit of a problem for investors because they know that interest rates are going to be higher for longer. But we would need to wait and see if investors will start to think, I'm just going to go to Bitcoin because it's the only thing that's moving up. Okay? If the flash manufacturing data comes in and it's saying it's contracting at 49.9%, 49.9, if it comes in lower than 49.9, that's good news because then it will speed up the process of the Fed giving more rate cuts, which would then naturally reduce the expectation of interest rates staying higher for longer. Okay? If we get existing home sales coming in lower, and they are expecting it to be a little bit higher, but they're expecting new home sales to come in lower, all right, then that shows you the economy is contracting. So GDP is contracted. Manufacturing data, hypothetically, is contracting because it's below 50 anyway. So all of these metrics that are coming into play tomorrow are effectively going to give us the idea as to whether or not investors will start to go back into bonds and lock in these yields. Do we understand that? Just give me a hey, yeah, hey, no. Tell me if you understood what I've just said then. Type 1 in the chat because I will reiterate that because it's really important that you understand that. This is how you can then premeditate the idea of what investors are likely to do. Okay, because what you're watching in terms of the charts is not candlesticks, it's not patterns, it's intention, it's perception, it's the idea of yes or no. This is a good investment, this isn't a good investment. Yeah? Yes, you understand that. Yeah? Two. Someone said 2 for the nature of the gentleman who said 2. Right. Listen, tomorrow's data, okay? This is going to help Bitcoin, right? If tomorrow's data shows the unemployment claims comes in lower, that's good news. Why? Because it will steer the Fed to try and cut the rates. If it comes in higher, it will just go with their narrative about, sorry, if it comes in higher, then it would give the Fed the narrative that, yeah, they might need to cut the interest rates because less people are actually working and that slows the economy down. But the economy is already slowing down regardless of what they're saying, okay? Your GDP is contracted. That means your economy isn't moving, okay? Flash manufacturing data is suggesting a 49.9 reading. That means it's already contracted. So there is already a problem in the manufacturing sector, okay? A reading below 49.9 will be bad because it means the Fed needs to do something to stimulate the manufacturing sector. How's it going to do that? By cutting the rates. If the existing home sales comes in lower and the new home sales come in lower, then that tells you that there's not many contractors out there offering work, taking on business to go and build new homes. That means there's not a demand for people to buy new homes. There's not a demand for people to sell existing homes because people aren't going out seeking mortgages because it's too expensive. That's a reason to cut the rates, okay? Now, if that happens and all of this here shows negative readings and it's bad, short term, you'll see volatility in the market, but there will be a transitional shift. Why? Because from now until that point, the yields are moving up and investors are going to wait and see if they should sell, buy the bonds and lock in yields at these high rates. Because remember, this bond auction today says that investors are seeking higher rates of return because they didn't commit too much liquidity on the 20-year bond auction. So if tomorrow's data comes in and it's bad news for the US economy and it represents that the economy is bad, that would then fuel the idea that investors' expectations of interest rate cuts will come in. That means the Fed's going to have to cut the rates, which means that tomorrow, based on that data, if it comes in negative and it's bad for the US dollar, the yields will spike up for a moment, but then they will instantly come back down again because that action right there on this bad data would then force the investor to get out of wherever he is in terms of safe havens, lock in the yields on the bonds, and then when these yields get locked in, the 2-year will reverse from 4%, the 10-year, 5-year would reverse from 4.15, and the 10-year would reverse from 4.59. They would then lock in the yields because they would say, yeah, I'm satisfied that the Federal Reserve has got enough data now to cut the rates. So they will lock in those yields right away. That would then naturally bring the 10-year bond market back up. Because look at it. It's taking a nosedive, ladies and gentlemen. It's not looking good for the bonds. Okay? And that is going to grab a lot of people's attention. Which naturally, in turn, if the bond market starts to go up and the yields go down, the stock market goes up, Bitcoin sustains itself and continues to go higher. That's how you marry up the macros, because you're in a macro-driven environment. Look at what they're saying in these titles. They're not talking about triangles. They're not talking about patterns. They're not talking about bullish candles. They're not talking about anything. When you understand that stock slide as weak treasury sale lifts the US yields, you've already got a bias in your mind that investors are not satisfied with the current rates. That means they could have an expectation of higher rates in the future. They want higher rates of return on the yields. So they're not buying US bonds. Where could they be going? Well, they could be going to the alternatives. Yen, safe haven. Look at it, trading upwards. Let's go over to gold and have a look at that. Gold trading positive, 0.82%. So gold moving up could obviously give us the idea that maybe the rates are going to get cut, because if they aren't buying the bonds, then they're obviously waiting on the idea that this data is going to come out terrible and the projections for it are pretty bad anyways. The expectation to cut rates in the future could be coming into play with gold's price going up. Look, it's only going back into the vectors. I've been saying it to you all. They're hedging for the next event. This could be one of those events. Capiche? I hope that makes sense. Do you know what, guys? This is, let me explain something, right? The world of finance itself, okay? How long has it taken me to understand this? Well, I'm the guy that sat down and read every single article that you could. I've read so many books, so many things on economics, right? Mathematical formulas, not interested in mathematical formulas, okay? I'm interested in the theory behind economics. But then when you've got a theory, you then need to look at the practical side of things and what does it mean, okay? So when you understand what the yields are and what the bonds are, it's people committing money to the US government so that the government can go put that money to work. And then you get a return of 4.1% on giving the US government money. Now, you're either going to go there or you're going to be like, hold on a second, things are looking good across the board. I'm going to go over to the stock market instead. So then you're going to take that and say, you know what, I can get a better rate of return going over to the stock market. Cool. Look at hedge fund managers, right? If they can hit at least 3-4% at the end of the year, they are laughing. They are laughing their heads off, which is why the yields are so subject to changes. Oh, sorry, should I say the stock market is so subject to changes because when you've got an asset class that offers you 4.5% and then your year-end goal is to achieve 3-4% for your hedge fund, okay, you're looking at things and saying, hold on a second, I might just put my money over there. At least I know I'm getting my risk minimized by holding US bonds. Remember, the yields themselves are about not just about what prices they are, okay? Each point in the chart that you see the yields turn from is demand for bonds. And you can see it's been a volatile time. You can see that there has been this up and down with investors' expectations of the future. What you want to see is you want to see yields just rolling over. And nice and slowly at that as well. You want to see yields going down because it means that investors are slowly just piling up bonds and bonds and bonds. And if they're happy to go into low risk, then naturally as the yields go down, tech companies are going to be subject to less rates of interest. So it doesn't cost them as much money to borrow dollars, to put dollars to work, to do research and development, to then offer new services for for their clients, for their consumers, and then happy days. Investors then go into the stock market because it's cheaper to do business. The problem that we've got is one of the major assets in the stock market, Nvidia, okay? Given that it trades around $2.5 to $3 trillion market cap, when the yields go up, it doesn't help them as a tech company, you know? So let me just put this into perspective. Now, Nvidia doesn't really have that much debt, but let me just put it into perspective for you so you understand what I'm talking about. Here we go. Nvidia, look. So let me just go to the metrics of the company. It says here that they only have around 11% debt, okay? 40% of funds hold this stock, 4% is management, and 1% of it is banks, okay? But look at the fund managers. Over the last 2 quarters, there's not been that much development in terms of fund ownership. Since December 2024 to March 2025, 4 funds have joined the bandwagon. Gangbang. 4 funds have joined the bandwagon, okay, and started to accumulate. That's no good. Look at when we started in June 24. Went from 8,109. Next quarter, another 200 funds came in. And then after that, another just shy of around 200 funds came in afterwards, okay, just above, right? But now we've only had 4 more funds. That's no good, okay? It needs to be growing to show investors interest. So if there's not that many funds playing Nvidia, some of those funds could be reluctant to get involved because of the state of where the yields are, okay? So yeah, I hope that makes sense for you. There we go. Imagine longing the top. People do. Anything else, ladies and gentlemen, other than that? You know, I don't understand your logic. Here we go. I don't understand your logic behind the bonds going up being bad for equities. The bonds have been going up on the macro scale since 2008, but equities have been performing just fine. Look, when we look at a bigger picture of things, okay, let me just show you this, all right? Let me just show you this chart, just to put it into perspective, right? That's your Dow Jones. Looks absolutely horrible, doesn't it? Now, let's just look at the last 12-month candles. No, not that. No. Okay, wait there. Let me just show you this. This will put things into perspective for you, all right? Look at this. All right, look. Your Dow Jones is up 71% in the last 5 years, right? We've got nothing to worry about. Stock market has a 100% success rate of recovering from corrections. It's up 71% in the past 5 years, right? So when you say to me that you don't understand why the bonds, I'm going to read it out, why your bonds logic going up being bad for US equities, the bonds have been going up on the macro scale since 2008, but equities have been performing just fine. You've got to understand, yes, over a long period of time, the bonds are going to sustain themselves and they're going to keep on marking higher. That's what happens. But we're talking about investing from a 1 month to maybe a 3 month scale, okay? Or you've got, depending on what your window is, if you're just buying and holding and you're never worrying about anything, it doesn't matter the changes in the bonds or the frequency of bonds movement. It doesn't matter to you. Because if I just pull up the 10-year bonds right now and we zoom out, the bonds have gone nowhere. Look, your bonds are going nowhere. They're just stuck in this range. There's no trend. It's just up and down, up and down, up and down. There's nothing there. Look, there's your bond market, all right? It's pretty much stuck in that range, okay? But the bonds will always be subject to changes in interest rate policies. They will always be subject to changes in precedents. They'll be subject to events that happen. And what you got to look for with the bonds is this: the psychology behind why someone would put their money in low risk investments as opposed to high risk investments. Okay? And how long do they maintain that thought process for? There are two things that you need to be seeing happening in the marketplace, ladies and gentlemen. When the bonds go up and the yields go down, fundamentally, the stock market should be going up too. Why? Because it means that investors are happy to take on low risk investments. And if the yields are going down and they are down to a level that would then grant investors to go and approach the stock market and take on higher risk, well, they'll then say to themselves, okay, I'm going to pick up a bond right now and lock myself in 4%, okay? And then I'm going to go over to the stock market and start buying stocks, right? If the yields are looking like there's a lot of people doing that and the yields are going down and the bonds are going up, that means there's a happy medium with investors that are happy to put low risk and high risk at the same time. Conventional investment portfolio practice says that investors would then do a 60% in stocks and shares and Forex, real estate, and then 40% would go into the bonds market, okay? So one asset class takes up the majority of an investment portfolio firm's approach to splitting risk. The other 60% is made up of stocks, high-risk assets split across various asset classes, right? But with the bonds market itself, if there is no, how can I put it to you? If there is no happy medium with the bonds market and the bonds are all up and down and there's no consistency, and 1 minute the yields are like 4.5. Look at the 30-year yesterday. It spiked to 5%. Okay, this shows you investors are demanding more rates of return. And it can go very high as well. Well, at a time in 1988, it went to 10%. And we're climbing up pretty aggressively at that. So that could be a little bit of a problem for us if investors are still thinking that they want higher rates of return on holding US debt. That squeezes the United States massively. Now, Besant did dismiss the idea of the downgrade, but if these yields keep on going up, it's going to be a problem for the markets. That is where Bitcoin comes into play, because Bitcoin technically shouldn't be subject to tariffs. Bitcoin should not be subject to yields. Bitcoin should not be subject to the appreciation or the value of the dollar or not. It should just be Bitcoin. Buy it because there's a supply and it's dwindling. 500,000 and plus is over here. And that's not including Strategy's amount. So we know 1 million's been taken. So 21 million supply, 4 million of that has been lost. And now you're just left with these fat cats picking up the Bitcoin. It only makes sense that Bitcoin is going to continue to go higher, but we just need a bit more confidence from the street to start going into it, because that's what's going to send Bitcoin higher and higher. We just need that one event. I think the bond market crashing and America loses its status. Trump is there with his hands in his head, like, I shouldn't have done this, I shouldn't have done that. The deficits are really causing a problem for us. Investors will rush to Bitcoin. So I guess that's why they've set the groundwork for that event. You'll see 1 million Bitcoin in this ETF balance, and the ETF price itself will go to about $150. You heard it here. Time frame? Well, it all depends on how soon the bond market crashes. They ain't buying bonds. So, and that's the highest they've had it. 11 basis points since 2000 and high since October 2023. When you get those big spikes out of nowhere and for a long time it hasn't happened, it tells you that there's a change in things, you know? Anyways, with that being said, ladies and gentlemen, mad love and respect. Hope you've enjoyed that. Be sure to like and subscribe on the way out. Try and make sense of this madness in this game is very difficult, to say the least, okay? But if you can just pin down the idea of marrying the logic of why would someone want to buy this asset and why would someone want to buy that asset, and when you pull the collective together, you know, it does give you a little bit of an edge to succeed in this game. Just don't get emotional about it. Don't FOMO. And that's all I can say to you. Have a great evening, guys. Mad love and respect. Peace.